Yeah, I'm here. Yep. Okay, great. Good. Yeah, I'm here. Yep. Yep. Okay. I didn't see it show up on the other device. Okay. All right. Yeah, I see the Skype. Okay. Yeah. There it is. Okay, good. All working. All right. Okay.
Hey everybody, this is Jose Blasco. Just a quick message to say that we are starting in around 5 minutes. Hello everyone, this is Jose here. We're about to start in just a few seconds. Please go ahead and give me some sound check confirmation whenever possible by typing a quick hello or a quick sound is okay on the comments box so that way we know we are ready to start. Thank you so much, guys.
Okay, I'm off mute.
Wonderful, everybody. Time to get started, isn't it? We just reached the top of the hour, so it's time to start our special session today. So welcome to the session. My name is Jose Blasco. Today is 11th of June 2019. In the western part of the world, in the eastern part of the world, it's already June 12th. So good morning or good evening, depending on where you are in the world. So today we're gonna be running a special session, as the name suggests. It's gonna be special in the sense that most of the times it's been me conducting sessions, getting together, getting us to trade, getting us to sharpen our skills. But today we have a very special person, a very special trader with us that is gonna be conducting the session, talking about a very special application on how to use options for intraday trading. So very, very exciting, as well as very exciting to see many familiar names joining us today in this special session, special time as well. Okay, before I pass the microphone, I need to go over this disclaimer, so I'll do it quickly. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. And as I said, while most traders think of using options for swing trades or even investments, our presenter today has mastered a very specific way on how to produce short-term profits by trading options intraday. He's an amazing UFO trader, and his name is Chuck Phillips. So I'm gonna stop sharing my screen and turn on Chuck's screen. Here we go. And as well as we now have Chuck microphone activated, and therefore, Chuck, the session is yours.
Okay, great. Thank you, Jose. So this is the first time presenting with Jose, and things are a little technology challenging because we're on Skype and YouTube and two different monitors, and things are a little delayed. So I will see your chat. I'll try and keep in touch with your chat while I'm doing my presentation. But I wanted to thank Jose for bringing me on here. I appreciate all the work that he does in his webinars. As if you watch them on a regular basis, you know that he doesn't just talk about the UFOs, he talks about trading in general. And so I'm going to keep in line with that. Most of you that already use the app already know how well it works, so I don't need to convince you of that. So I'm just going to talk about the way that I trade. Okay. If you can't read the note here, I know it's a little small. It says, Chuck P takes great joy in another successful day trade. I day trade options. So I'm going to go into the ways that I do that. I'm going to cover a lot of general stuff. I'm not going to get down to the nitty-gritty of my exact plan, because even if I tell you how I do it, you're not going to trade the same way that I do, and I'll show you some examples of that. So we'll get through that. Let's start with a room overview. Okay, so I'm just curious how many of you do not trade options right now, or if you do trade them, you feel like you need a lot of help. Okay, so if you want to mention anything about your struggles with options, you can do that in the chat, and I'll try to respond. If not, that's fine too. We'll just keep going. So a little bit of my story. Okay, I'm gonna wait for the screen to catch up. There we go. Okay. Yes, it will be recorded. So I started trading back in, I don't know, 1996, 1997, somewhere's in there, with a program and a guy named Wade Cook. Some long-term traders might know of him. He had some solid ideas. Nothing as advanced as what I'm doing now, but that was my start. And I was in Silicon Valley at the time. I was a computer programmer and karate student. And now I'm back home in Minnesota where I grew up. And I do two things basically for income and pleasure. And that is my karate dojo. I run a karate school and I trade. And a little poker on the side. Okay? But that's my basic thing. I got involved with other trading. Yeah, the taxi trader. That's right. Somebody remembers. I got along the way. I found a few other different strategies and different people giving advice and everything, and people that just would sell you their recommendations for trades. About 6 years ago or so, um, I stumbled upon Online Trading Academy. Some of you I know are in there as well. Some may be new to that. I know that's where I met Jose, was Online Trading Academy. And it's quite a different thing. It's a whole educational process on how to trade, not just they don't tell you trade this or that. And their process works with any asset class: forex, futures, options, stocks, long-term, short-term. It's quite useful. So if any of you are not a part of OTA and you want to learn more about it, you can certainly contact me. I'll give you my email at the end, and we can talk about that. I'm going to put up my own personal disclaimer because I'm presenting this information just for educational purposes and kind of make sure that everybody understands that. Generally, when you get to the end of it, I kind of know because someone will type something in the chat. But this is just the way I trade. It isn't necessarily good, bad, beginner, expert. It's just the way I trade. Okay, so. SG, do you know the style of karate? Goju-ryu, Uechi-ryu, Ishin-ryu, Shotokan? Just curious. Okay. So there's that. We read that. Okay. Along with the disclaimer, you'll see this screen come up that has a couple of portions of a chart on here. Okay. So the two blue lines on the left at the bottom would be your UFO, and you can see that price did not come down to that. So it came close. So if you jumped on that trade and I didn't jump on that trade, we wouldn't be trading the same way. The same thing with the big wick at on the right. If you love big wicks, you're going to take that trade. If you think big wicks are scary, you're not going to take that. Okay, so everybody's trading style is different, and you have to keep that in mind when I'm telling you the information that I share. Okay. So what I do is, as I said, I day trade, and I day trade credit spreads. Okay, and I do this on gaps. Okay, and if you haven't figured it out yet, I enjoy cartoons. This is Ballard Street. Okay, and I enjoy Ballard Street because I can relate to it in a lot of different ways. So just a little humor. Okay. Oh, D-Hide, good for you. Okay. So credit spreads, for those that don't know, you sell an option and you buy an option to cover it. Okay. Let me jump over to the next screen here. Okay. You'll notice my high-tech screen hider, okay? Because I only want to see one line at a time. Okay. In a credit spread, 2.5 out of 3 times, you make money. Okay, and you're not going to get those odds much anywhere. Okay, if I jump over here to the chart, okay, and we look at IBM, Just as an example, I've got the UFOs on here. Okay. You can see that there are 3 levels of support down here. Okay. So if I sell the 135 put, that gives somebody the right to make me buy the stock at $135. Okay. So I might come under here and I would then buy the 134 put. Okay. So that if somebody makes me buy it at 135 and it falls down to 130, I can make somebody else buy it from me at 134 and I only lose $1. If it tanks down to $90, I still lose only $1. So this is a credit spread. You sell the put above and you buy a put below, further from the money. Okay? Because the one below is further from the money, it costs less. Okay? The one that's closest to the current price costs more. So if I sell the 135 for $1.20 and I buy the 134 underneath it for, I don't know, 80 cents, then I'm making 40 cents on the deal. Okay? Here's our current price. Okay? Oops, let's get rid of that. Try this again. Okay? Here's my current price. As price starts moving down, okay, that's not good for me. I want it to go up, right? Okay? But as long as it stays above 135, I'm okay. Okay? If price goes up to 136, they're not going to make me buy it at 135 because they can sell it at the open market for 136. If price stays flat at where it is, okay, they're not going to make me buy it because it's already higher than 135. If it even falls down past 135 to 135.90, that's 10 cents below the strike price. They may sell it to me, but I got 40 cents. So even if it goes the wrong way, my net is still 30 cents. This is the only asset class that I know of, and the only trades that I know of, a credit spread, where you get paid up front and you keep the money even if you're wrong on the direction a little bit. Okay? So as long as it stays above my price or my break even, okay, I make money, right? So that's why I like credit spreads in general. Okay? 2.5 out of 3 times you make the money. Just on paper. Okay? It doesn't matter how good of a trader you are. Doesn't matter if you're right in direction or not. Just on paper, 2.5 out of 3 times you make the money. With a credit spread, you get that credit. You get it paid up front into your account. You can use that right away. Okay? There's what they call slippage between the bid and the ask on options. Okay? Most of the time with a credit spread, I can take the midpoint, okay, because I'm doing 2 legs and the market maker is willing to split that with me and I can get a better price. So I don't have to take the natural. Okay? So if I'm selling the 135 on IBM and the bid-ask spread is $1.10 by $1.30, the natural would be the $1.10, okay, is what I get paid. Well, I can go to $1.20 and get paid rather than go up to the $1.30. I can take the midpoint. The same thing with the other leg. So I get that spread a lot easier, and I avoid that problems with the bid-ask spreads. And of course, there are the usual options information. I give a short-term turnaround with the credit spreads that I trade. I have leverage, so I have better buying power with things like those big stocks that are, over $100. It's very hard to buy booking at $1,500 a share, but I can control 100 shares for a relatively small amount of money. Okay, so I have a lot of leverage with that, right? So that's why I like credit spreads. Okay? So why do I day trade gaps? Okay? It's because often when a gap comes into the market on an equity in the morning, it will gap to a certain area of unfilled orders. Okay? Institutions have a bunch of orders sitting out there waiting for price to hit their target. Okay? Whether it's up at support or up at resistance or down at support, doesn't matter. Okay? They've got the orders there. And you can go back with the UFOs and find where they are. That's what they do. That's what the app does. It goes and finds those unfilled orders. And a gap will open often at that area of unfilled orders. Whether it's up at the top or down at the bottom, doesn't matter. Okay? So you're already opening into an area that there are orders waiting to be filled. And of course, if there's orders waiting to be filled, they get filled and your market runs out, and now you've got to raise price or lower price to get more people to come into the market. Okay? So IBM closes at 136 and it opens at 134. That's a $2 gap. Okay? And people start selling off because they figure it's going down. Well, that's right where the institutions are saying, okay, you sell, I'll buy. And all those buy orders make it go back up, and it closes a gap, and I'm out of the trade. Okay. So very often a gap will close on a single day, depending on how far it gaps. Sometimes it won't, okay, because it's just too far of a gap. But that's what I look for, is I look for that gap to close on a single day, and I'm in and out. Okay? And often it's in and out within 30 minutes of the market opening. Okay? And I'm out and done. Okay? I got really good at understanding the gaps and studying them and learning them. At one point, I looked at 100 gaps every day for 100 days. So I looked at 10,000 gaps. And I just didn't look at the chart. I had a whole ton of questions about how they behaved, how much of a gap percentage, the dollar amount that it was, a whole bunch of stuff. And I put it in a spreadsheet, and I lined up the spreadsheet, and I analyzed it all after I did the trades. And so I learned a whole lot more about it. But in my whole trading the past 5, 6, 7 years, I'm terrible at dates. I've probably looked at 20,000 gaps because that's what I specialize in. Okay, and to take a single leg long on a gap is really hard sometimes, because what happens is when the price opens, the market maker doesn't know if it's going to fade the gap or if it's going to be a gap and go. In other words, if IBM closed at 136, it opens at 134. The market maker doesn't know if it's going to go back up to 136 or if it's going to keep falling down to 130. And so they open up the bid-ask spread even wider, okay, because they're not sure, and because they also know that there's going to be some panic when that gap happens. And when there's panic, people are willing to get out at any price. So the market maker makes more money if you take a single leg long. But with the credit spread and having two legs, I can get that midpoint, and I don't lose money that way. Okay. So let's take a look at some of the things about how we're going to find the gaps. Okay. If you're quick, you can read that. If not, oh well, we'll get to it. Okay. So the first thing you have to do is eliminate the noise. Okay. There are gaps there are stocks that gap all the time, and you have to figure out which ones are better than others, because not all gaps are created equally. Okay, and through my study and learning how gaps work, I've been able to figure this out to a relatively consistent degree. Between the number of gaps and volatility, no. But there is the individual gap A gap creates volatility. But as far as how many, and also other things create gaps. I mean, volatility also creates gaps. If the market is unstable, there's a higher chance of more stocks gapping. You'll see that if President Trump tweets something overnight and it causes a panic in the market, you're going to see not just the S&P and the Qs and so forth, the Dow gap. You're going to see a whole bunch of stocks gap. Okay. Yeah, overall volatility will cause more stocks to gap. Okay. So what you have to do is figure out which ones are useful to you, right? And so my first pass is I won't look at the ETFs. I'll look only at stocks. Okay. So I eliminate all the ETFs because ETFs don't behave the same way as stocks do. Okay. So I only look at the stocks and I only look at certain prices. Okay. $60 and above. Because the smaller priced ones don't provide enough leverage for me to make enough money in my credit spreads. Okay. And you can see the gaps in pre-market and post-market charts. Okay. No, I don't disagree with them. What I do is I use the inside wick as a way to set up alerts. I'll show you that when we go to the charts. Okay. I'll show you how I use that. Okay. But let me look over here. We'll look at IBM here. Okay. I'm going to go up to the top here and hit sessions and change this to stocks with pre and post market. And you'll see that this screen here, okay, has got light pink and light green. That's pre-market and post-market data. And so you can see where there's trading before the market opens and after the market closes. Okay. So I'm looking before the market opens to find price movement that will be in line with a UFO. Okay. Now I'm not saying this is or isn't. I don't have the UFOs turned on in this window, but you can see that price opened at this pivot point here. Okay. Over here, or it got up that high, and then it came back down. Okay. So that's the kind of thing I'm looking for. Okay. Let's go back to here. Okay. So I'm looking pre and post market. Okay. TradeStation has something called hot lists. And in the hot list, there are all kinds of things. Gainers and losers. One of the things that they have is they list gaps. Stocks that are gapping up or gapping down. I use the one that's percent, not dollar sign, because I want the gap to be 4% or higher. That's just a number that I use that works for me. You can use any number that you want. Okay? But I want it to gap at least 4%. Okay? Now on higher price stocks that are over $100, that gap can be as low as 2% and I can still make money on it. Okay? But generally that's what I'm looking for, is that 4%. Okay? I want the volume pre-market to be at least 3,000 shares traded. The reason is that they have to have some skin in the game before the market so that I know that that gap is going to move. Because if you look at some of these, it'll show that it's a 10% gap, but there's no volume. And then as soon as the market opens, it just opens where it closed. So those are useless. So by having something in the game, okay, and I just picked 3,000 shares. It can be more if you want. It's just something that works for me. That allows you to eliminate the ones that have no shares. Okay. Royce, I cannot show you how I set up and calibrate UFOs because it's outside the scope of what I'm doing here tonight. There are recordings of how to calibrate, and it takes about 20 minutes to explain it, and that would be a lot of time that we wouldn't have to show you the stuff that I do. Okay? So what I'm showing tonight is how I trade to give you an idea of something else that you can put in your toolbox. And I'm going to give you more than just the gaps. There's a couple other things I'm going to do as well. Okay? So if you send in a help request or a note to Jose's team, they'll tell you which sessions you can go back in time with. And if I have time, I can look them up because I've got a couple of them that he sent me that I can show you. Okay? So this is what I look for. Okay? Is I look at that hot list, I look for the percents, I look for the volume, and I do a quick visual check of the stock chart itself to decide if it's visible, if it's usable to trade. Okay. If you look at this next chart here, you can see this is a 15-minute time frame. You can see just by looking at it that this is not worth trading. Okay. It's way too sparse of pricing, and it's all over the place. So just by doing that quick check, you can say, oh, this isn't for me. And you go to the next one, right? Okay. And you can add in there, if you know how to create a scan in TradeStation, you can create a scan with the stuff I just showed you on the previous screen, but you can add anything you want in there. You can add volume, ATR, beta, open interest, whatever you want you can do. And you can get rid of all the noise. Okay? All right. So the actual trade entry, okay, on these gaps, okay, I'm going to pop over the next one. I wait for the first 2-minute candle to develop, and I want it to develop inside the UFO. Okay? And I wait for that candle to print. And then I look at the second 2-minute candle, and I look how it behaves according to the first 2-minute candle. I'll show you on the graph, on the chart. It's a little easier to understand on the chart, but this is what I do here. Okay? And I want that to move in the same direction as the first one. So if it gaps down, the first candle should print green. The second candle should print green and start moving past the close of the first candle. Once it moves past the first candle and it shows me that it's going to continue that way, I jump on the trade. So I'm in the trade in the first 3 minutes, possibly the first 6 minutes, or I don't take the trade at all. Okay? Market opens, I wait 2 minutes. And then I wait for the second 2-minute candle, and as that candle prints into the 3rd minute, sometimes into the 4th, and then I wait for the 3rd candle to print maybe, okay? I take that trade. Okay? Let me see if I have some charts here. I think I do. Yeah, so here's iRobot. Okay? I'll show you this next chart here. So you can see the first 2-minute candle. Let me try and blow this up a little bit. I guess that's as big as it goes. All right, so this first 2-minute candle, okay, prints. The second 2-minute candle starts below, so it gaps down actually from the close of the first one, but then it quickly moves up. Okay. So I'm in that trade, and you can see that it goes up and it virtually closes the gap. Okay? And I'm out. And that's 1, 2, 3, 4 candles. So that's 2, 4, 6, 8 minutes. And I'm out of the trade. Now, if you want to, a lot of times, when a stock closes the gap, that gap acts as a resistance. And it will turn around and go the other way. And you can see that's what this did. So you could sell your credit spread on the bottom. It closes the gap, you get out. Now you can do a credit spread, a bear call spread, and you can sell that. And it comes back down to where price opened. That opening now is a UFO. You close it out and you go up. You could have taken this for a triple in one day. Okay? That's a gutsy trade. That's hard to do. You've made some money and now you're risking it and you're going to give it all back on that downfall. Okay? So what you have to do is you have to have rules about what you're going to do. You can't just say, okay, today I'm going to do this, and tomorrow I'm going to do that. You have to have rules on how you're going to get into these trades, where you're going to get out of them, whether you're going to take the double or the triple. You have to have all those rules set up before you even get into the trade. And you have to be able to figure that out and practice it, right? Let's take a look at another one. Okay? Oh no, I got to go to the next slide. Hang on. Okay? Talking about the rules, right? Here we go. Okay? So my rules say that I have a target set up before I get into the trade, and that target is that I want it to transverse the gap, meaning that I want it to go up into the close of yesterday and keep continuing up higher. That's the best option. Okay, but I found that in my study, only about 38% of the gaps actually transversed the gap, meaning it went past the close of the previous day and kept going. Okay, and that's either up or down, because I didn't look at just stocks that gapped down and moved up. I looked at them both ways. Okay. So second best obviously is the gap closes. Okay. And then if it my other target is if it starts moving up and it starts basing in the middle of the gap, and then it starts moving down past that basing, I'll get out. But if it bases and then continues to go up, I'll stay in. But these are things that I have set up ahead of time, and I know how to do them because I've practiced it for a long time. Okay. That's the chart and how it prints. Okay. But I'm also looking at the dollar amount as well. Okay. If I get $1.40 on the open, I'm looking to capture 70 cents of that, 50% of the premium that I received. Okay. But at 50%, if it continues to move up, I'm not going to get out just because it hit my 70 cents, my 50%. I'm going to see how that chart prints and how it behaves, because I might get it down to 60 cents or 50 cents, something like that. And why take the money off early if you don't need to? If the stock's continuing to move up, let it move up. Take the trade and stay in it. Okay? And I'll put in a trailing stop instead. Okay? The last thing that I look at, okay, is when to get out early if things go wrong. And I'll show you some of that on the charts. Okay. But regardless of that, with all the stuff above, at the end of the day, I close the trade. Doesn't matter where it is. Okay. In doing this, I've been doing these gaps for probably 3 years now. And in all those 3 years, I've only taken a trade and taken it and held it overnight 3 times. So I can't say every time, but pretty much every time, okay, I get out at the end of the day. Okay. What time frames I use? I use the weekly to give me the overall view, the daily to give me the trend idea. I find my UFOs on a 60-minute. This is not, it changes back. Find these UFOs on a 60-minute, and then I trade on the 2-minute. Okay. Now, once I'm in the trade, I'll change that 2-minute to a 5-minute, and sometimes a 15-minute. I don't stay at the 2-minute once I'm in it. Okay, because that's just too much volatility. Okay. So I like to change it over and put it on a 5-minute so I can watch the basing or the development of the trades. Okay. Got worms. I'm not sure what you mean by 2-minute candle basing. You'll have to put in a couple more words in there. Help me out. Okay. Let's go back to where we were on the chart on the presentation here. Okay. Oh yeah, we got to go back. Okay. We'll see if you see that. I'm going to wait for this to print on the YouTube screen so you guys can see it. I forgot that slide was coming. Did you get that? Did you read it all? Okay. This is an important lesson for people who, oh, okay. I got it, Worms. No, I don't stay on the 2-minute. I switch over to a 5-minute, and that's where I look for the basing or for it to close the gap or whatever. Okay? So, that screen that just flashed up there, okay? Yeah, I use the 16-minute for the UFOs. A lot of people don't understand this 50% rule that I have. Okay? I get out at 50% of the premium received. If I get $1.40, I'm looking to make 70 cents. If I get $2, I'm looking to make $1. Okay? This applies to my swing trades as well, because I do swing trades with credit spreads. Okay? You're putting yourself at risk every minute you have your money out in the marketplace. The longer it's out in the market, the more you're risking, right? If I get 50% of my premium in the first 8 minutes, why do I want to stay in there the entire day and risk my money for the entire day? Okay? So the analogy I use to help people understand this is you're in an auditorium. Okay? You're at the front of this auditorium with a guy who's willing to pay you $1,200 to walk from the front of the auditorium to the back of the auditorium. Your friends are there, your relatives are there, okay? You have complete strangers there. Let me finish this thought and I'll get back to transverse the gap. And he says, you got to walk from the front of the stage to the back of the room. And I'm going to pay you $1,200 to do it. But I'm going to do it in increments that I want. The only catch is, okay, you have to be in your bathrobe. Nothing underneath, just your bathrobe. As soon as you start walking, you open your bathrobe. You can close your bathrobe at any time and stop. And you get whatever money he gives you. If you get all the way to the back of the room with your bathroom open, you get the full $1,200. What you risk is everybody seeing you, laughing at you, taking their phone out, finding their camera, taking pictures or videos of you every step, right? Okay? That's what you're risking. Okay? Well, what if he paid you half the money up front to take one step? Okay? So you open your bathrobe, you take a step, and you close your bathrobe. How many people are going to see you? How much risk do you have? Okay? Every step you take is a decreasing amount of money that you're going to make. By the time you get back to the back of the room, that last step pays you $5. In options, that's 5 cents. Right? So why would you risk all that? Okay? That's why I take my money out at 50%. Okay? Let me see what my next slide is here. Okay, we can go there. All right, so transverse the gap means that it goes past the close and continues to move in the same direction. So if IBM closed at 136, it opens at 134 and starts moving back up 134.50, 135, 135.50, 136, and it continues to go up to 135, 6.5, 137, and so forth. That's transversing the gap. Okay. That's true, you do eliminate reward, but I prefer to take that and not be in it. Okay? If I'm in a swing trade, all my credit spreads are 2 weeks or less. So if it opens on Monday, I'm looking to take an expiration on Friday. At worst, 2 Fridays out. So I trade the weeklies. Okay? If I get 50% of my profit from that swing trade in the first day on Monday or on Tuesday, I'm going to take it off the table. Why would I leave it sit out there for Wednesday and Thursday and Friday and a whole nother week? Okay? Anything can happen. Okay? You're leaving yourself at risk. Okay? Looking at FB's question here. Okay? I don't play gap and goes. I play fade the gap. I'm starting to work on gap and goes. Okay? But I'm only experimenting with them. It's not my forte. My forte is gap and fade. Okay? But yes, you could do that too. I know people who do sell bear call spreads on a gap and go. Okay, I'm looking at taking single leg longs because by the time it decides what it's going to do, I can generally get that in sim, not in real life yet. Okay, but this is one of the things that can go wrong. Okay, you got a green candle, okay, and then the next candle is red, and the one after that is red. I can't take that trade because it's not going to fade the gap. Okay, it's just going to sit there all day, as you can see. Okay. I use weekly expirations whenever I can. The only time I use monthly is if it happens to be within my time frame of a week or less, 2 weeks or less rather. Okay. Something else that can go wrong, okay, is it will fill the gap within 2 minutes. You can see that first candle opens, goes all the way down past the close of the previous day and comes back up again. You can't even get into the trade that fast. Okay? In and out and you're done. Okay? What if you get in and you send your order because you see it's going the right way, okay, and all of a sudden it bounces back just as your order gets filled? That's why I got to wait for the 2-minute candle to fill. I used to get into these with stocks. I started these gaps with stocks. And I would get in right away as soon as it started going my way. And I found after studying that and studying my trades that was not profitable. Okay? And decided that the 2-minute candle was the best one to work. Okay? Let's take a look at another one, something that can go wrong. Okay? And just for your information, it's very important that you understand the possibilities of what can happen that can go wrong, because you need to know what you're going to do when things go wrong. Okay? You have to have rules. Okay? Yes, I do trade the SPX. Okay? So here's a stock that just gapped up. Okay? It touches the zone and it may or may not go back down. Okay? I took this picture just as it hit the zone. Okay? So this looks like it could be a good trade, but let's look at the premiums. It might be hard to read. Okay. So that's at $95. So if I sold the $100, you can see the bid-ask spread is $2.50 by $7.20. I don't know if you can see it. It's kind of small. Okay. Well, that's really hard to do. To take even it's not likely that you're even going to get midpoint on that. Okay. 250 by 720. That's just crazy. So I can't take that trade. Okay? So even though there's a good gap, okay, it just doesn't work. So yeah, I'm going to show you a couple different ways you can trade the SPX. Credit spreads are nice. The nice thing is that with credit spreads, you get your money up front. It's 2.5 times out of 3 you get it right. But you don't make as much money as a single leg long. So there's other ways that we can do this, and I'll get to that in a little bit here. I'm getting a little low on time. Got to make sure I catch things. So let's look at some good trades. Okay. This is one that I marked out. I'm not sure when I did it. I don't remember the date. Looks like back in December. Okay, but we got Adobe coming up here. Okay, so I got in it at this is on a 2-minute candle. Okay, I got in it at $1.99 credit. Okay, as it moved down here and starts basing, okay, you can see it based twice. Okay, going down. Okay, and as long as it's based and keeps going down, I'm going to stay in the trade. So at the first really major one, it's at 93 cents. Okay, so I took it for $1.99. Now it's at 93. I'm going to hang on. Okay, it goes down to 66 cents at the bottom. Okay, it starts moving back up and it's broken that base and it's going the other way. I'm out at 75 cents. Okay, then it came back up to 90 cents and then I stopped tracking it. I said that's enough. Okay. So I got in for $1.99. I'm out at 75 cents. And that's 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 22, 24, 26, 28, That's 30 minutes. And the trade's done. Okay. So these are real short-term things. Okay. Let's take a look at the next one. This is NVIDIA. This is a gap up. That one was a gap down. This is a gap up. Okay. So we got our first 2-minute candle is green. It'll come up here in just a second. Okay. Yes, I only use the UFOs on this. No, that's not true. I use them in basing too, on a 5-minute chart sometimes. I personally don't use them very often on a live trade because I've got methods that I use that I'm used to that I don't need to use them. Okay, but I'm starting to bring them in, especially on the SPY and the SPX. I'm learning how to use them in my intraday trading to my benefit. Okay, but they can be helpful, yes. Okay, so I trade market order. No, I don't take. I do a limit. Okay, market order would be the natural, and I don't do the natural. I do a midpoint, so I have to do a limit order. Okay, both ways, in and out. Okay, if I don't get it right away, I'll shave a little bit, and I'll only shave twice. If I have to shave more than twice, then it's not going to be to my advantage to get into the trade. And I can tell that the bid-ask spread isn't going to be beneficial, and it's going to hurt me in the end if I try to get out on a bad trade. If I get out on a good trade, I won't make as much. Okay? So I'll only try shaving twice. So if the bid-ask spread is $1.40 by $2, that's a 60-cent spread. I can live with that because I can get $1.80 on it. So I'll try the $1.80. If it doesn't work, I'll drop it down to $1.75, maybe $1.74, depending on the situation. Some they only go by nickel increments. Okay, and if the $1.75 doesn't work, then I might try $1.70. If that doesn't work, then I got to get out. I can't stay in. Okay, I don't take the trade. So on NVIDIA here, okay, this came up. It didn't quite close the gap. Do you get out? It's starting to turn around. Do you stay in? You have to have rules that tell you what to do before this situation comes up. Because if you don't, you're going to panic and you're going to get out too early. Okay? Or you're going to stay in too long. Okay? You have to decide ahead of time what your rules are. Okay? Just knowing how price prints and knowing how to read the UFOs isn't enough. You have to decide before you ever get into a trade what you're going to do when it behaves this way, that way, or the other way. Okay? And so that's important to know, right? How many trades per day? The max is 3. That's just because that's all that ever presented themselves. Okay? I'm looking at 100 gaps down and 100 gaps up every morning through the hot list. I'll show you the hot list. I forgot to show you that. Okay? And I weed out the ones that I want. And it's anywhere from none. I've had days where there's just nothing to trade. Okay? To as many as 12. And I'll look at 12 stocks as they open. And as they print, I'll get rid of them. I'll show you how I do that, right, when we get done looking at these. Okay? But the most I've ever taken is 3 because that's all that ever presented themselves. If I did more, it would only be because the opportunity presented itself. But it's pretty hard to trade that many. Okay? You have to watch them all. All right, so this is my picture perfect trade. You can see the 2-minute candle, and then the second 2-minute candle gaps. Okay? Now you can't see it very well, but this is a wick down here. So it gapped up, it wicked down, and the bulls said, no, we're not going down, we're going up. So as soon as it started getting out to the green again, I got in this trade right in here, okay? Right at that second 2-minute candle. Okay? Here's the third 2-minute candle. It pops up and closes the gap on the third 2-minute candle. And I'm watching it, and it just flew up there. Okay? If you break this down to a 10-second candle, you could see how fast it flew up there. Okay? I got out immediately. I didn't even care what it was going to do because I was worried that it would just fly back down and I'd lose my profits. Okay? So this is my best. I'm in this thing on the second 2-minute candle. I'm out on the third or fourth 2-minute candle. I can't remember. It went so fast. Okay? But that's 4 minutes. I made $820 on that trade. I've got to read the chat here. Yeah, Maka. I set all these trades up pre-market. I look at them 30 minutes before the market opens. I start looking at all the gaps, and I weed everything out except for the ones I want to look at. And I set up all the credit spreads ahead of time. Which strikes I want, which expirations I want. Okay? I set all that up ahead of time. So all I have to do is click the button. Now there's a little bit of fidgeting you have to do in there sometimes. Okay? Sometimes you have to switch expiration dates. Okay? If it's on Wednesday, I can sometimes take the same week Friday, but I may have to jump to the next week to get a decent credit. Okay? My minimum credit is 60 cents. I always want 60 cents or more. Okay? Do I have a decision matrix with these metrics that you use? Yeah, I've been going through it. I mean, I've been talking about how I do all this. Okay? It's pretty much what I've been saying is my decision process. Okay? Now, I can tell you that I would take this one or that one, but we're not live, so you can't see that candle print. So you haven't seen these, 20,000 gaps like I have. So the way that it behaves and how fast it moves or how slow it moves is important as well. And that's just something that you have to learn going into it. You just have to practice it. Okay? How many contracts, Helene, is up to you. Okay? What I take and what you take are not going to be the same. The strikes that I choose are not going to be the same as the strikes that you choose. Okay? I'm more aggressive. You're more conservative. So it's not going to work. Okay? So it doesn't matter. Okay? How many I take. Okay? Or which strikes I take. Okay? Because you have to work this out for yourself on what you're risking. Okay? If I take a $10 strike price, IBM's at 136, it gaps down to 134. If I sell the 134, you might sell the 130. Okay? If I sell the 134 by 124, that's 10 points. You're thinking that's too much risk. Okay? Maybe you only do a 5-point spread or a 2-point spread. So it really doesn't matter. You have to figure out what works for you and what your tolerance level is. Okay? So sorry I can't answer that the way that you want me to. Okay? How are we doing here? Oh man, we're almost out of time. I'm going to run over. Sorry. Okay? All right, let's take a look at the next one. This is some other things you can do besides just the straight gaps that I play. Okay? I'm Minnesotan. Sorry. It's pretty close to Canada. All right, so this is, you could do this with stocks too. This is a $34, $35 stock. Okay, so if you took 100 shares on this, okay, that's $3,500. It moves up $4. Okay, on 100, that's $400 you're going to make. That's 10% on your $3,500 risk. That's not a bad deal, right? Yeah, South Canada, you got it. Okay, so there's other ways to trade these. Okay, well, whatever way you trade, whether it's Forex futures, doesn't matter. Okay, you have to remember something that's very important. Okay, and that's post-trade. Okay, after the trade is done, you have to record your trade in some type of a spreadsheet or a journal or software that they sell for tracking trades so that you can go and analyze your trades and you can figure out what you're doing right and what you're doing wrong. Okay? It's very important. Okay? So this is any stock, any gap that works for you, you can do. Okay, but you can also do other things. You can day trade the big boys. Okay, Tesla, Booking, Amazon, the SPX, the SPY, whatever. Right? Okay. In the case, have you thought of buying a call? Yeah, you could buy a call. The problem is, I already covered that. If you want me to answer that FB, you got to pay me $1 because I already answered that. I'm just kidding. Okay. The problem with taking a single leg long on most equities on a gap is that they widen the bid-ask spread. Remember that one that I showed you? It was, what, $2.50 by $7.20, right? You can't take a single leg long there because you can't get the midpoint. And if you do get the midpoint, that's too much profit that you're going to have to make just to break even. Okay? Now, on some of these bigger ones, like IBM, like the SPY, okay? The SPY is a real good one to do with if it gaps. You can take single leg long on that because most of the time those are only a penny or 2 pennies at the most between the bid and the ask. Okay? But on most of these, like the HCSG or Square or GameStop or all these other ones, the bid-ask spread is just too wide to make up the profit. So you got to go with the credit spread. Okay? So, but on these other ones, you can take a single leg long. Okay, on some of these, on Tesla, Booking, Amazon, some of these bigger stocks, they have 10, 15, 20, 25 points that they move on average every day. And you can take and do those. Okay? Here's one I have as an example. Okay? Is Booking recently. Okay? I don't tend to have the UFOs set to show when they break or when they've been filled, when they've been hit, I guess it is. Okay? When it gets hit, it disappears on my screen. You can set it so it doesn't. You can set it so it shows up even. Okay, but I don't. Okay, so this is Booking, came up into a zone, okay, into a UFO. Okay? At the point that I take this, you've got the bid-ask spread at 38.20 by 42.20. The midpoint is 40.20. So even if you take the natural on this one and you write it down, okay, at the bottom here, it's 48.90 by 51.40 with a midpoint of 50.20. Even if you take the natural on both ends, you're going to make money on this one. So you get in at 38.20 at the natural, you do a market order. I would never do a market order, but for the example, right? Then you get out on the other side at 51.40, right? I'm sorry, at 48. Yeah, you buy it. If you took the single leg long, buy at the ask and sell at the bid. So you'd buy at 42.20, okay, and you would. Is that right? Now I got them mixed up because I take midpoint so often. Okay? Well, you understand. Okay? Yeah, you buy at the ask, you sell at the bid. So you buy at 42.20, you sell at 48.90. You're going to make $6.70. If you happen to get the midpoint, you can make your $10. But it's not likely with Booking that you're going to get the midpoint on a single leg long. Okay? But you could do it. Okay? And even if you took the worst of it and took a market order on both ends, you're still making $6. Okay? On an intraday trade. Okay? Let's take a look at the SPX on an intraday trade. Okay? As soon as it comes up here. Okay? So here's the SPX. Okay? You can see it's got the open. It does a little basing, does another little basing, and it creates the UFO there. Okay? And then continues to go up. Okay? Well, what if you took your trade at that basing on the bottom there? Okay? I don't know if you can see this, and it's going to be a little hard to explain. Okay? But let's say you're risking $5,000. You put $5,000 into the market. Okay? On the left, you've got 3 contracts. Okay? You take your single leg long at $13.70. You sell it just below the red UFO at the top for $27.60. You net $13.90. It's a 201% profit. On the other side, you're open at the exact same place, okay, for $4.20 and get out at $12.30. You net $8.10 per contract for 291%. Okay? But because you're only doing $4.20, you can take 11 contracts instead of 3 contracts. So on the left, you've got $4,170. On the right, you've got $8,910. The difference is, on the left, you bought a at-the-money call and wrote it up. On the right, you bought an out-of-the-money call up near the red UFO. So on the left, we bought the 2860. You can see down on the bottom screen. I don't know if you can see it or not. And on the right, we bought the 2880. 20 points difference. The 2880 is way out of the money. Okay? But because it's smaller in price, you can buy more contracts for your $5,000. So there's just another idea of how to trade. Okay? Intraday. Okay? All right, we're almost done here. Sorry, guys. Okay? And that was single leg long. Okay? And by the way, those charts that are up there on the top, on the right and the left, that's the actual chart of the strike price that we bought. Okay? But whatever, this is, winding down here. Whatever you do, you have to have a game plan, right? You have to have a plan of action in place with rules before you ever start. Okay? And even that, okay, let's go back. I got one more slide here. Even that is not going to be enough. You have to have the mental fortitude to trade, meaning you have to have the psychology, you have to have the focus, the discipline, the self-control, the patience to be able to trade. Okay? Now, I sent out an email to a few people telling them about what I was doing tonight, and I promised you guys that I was going to share one more thing that I haven't shared with very many people. Okay? And that's that from time to time, inside of Online Trading Academy, and now with everybody else watching this, okay, I do some mentoring. I take students on one by one and help them with their trading. Okay. Now I charge an hourly fee. I'm not, my time is valuable, and I found a couple of things. If all you do is give free advice, it's worth every penny you paid for it sometimes, and the person receiving the advice doesn't consider it valuable, and they don't take it to heart. Okay? So I've only done this with a few people because I enjoy trading and I enjoy karate, and I'm just starting to get into teaching this stuff and helping people out. But I enjoy helping people out. Okay? Those that are in Online Trading Academy know that I give away a lot of information for free, and I have no qualms doing that. If you got 1 or 2 questions about what we covered tonight and you want to ask it, send me an email at this email address. I'll answer it. If it's too long of an answer, I will send you back a reply saying, I don't text, because I don't. My wife knows this. She hates it that I don't text, but I don't. I'll just call you, or you can call me. I'll say, I'm here Thursday at 5 o'clock. Give me a call. and we'll talk about it. No problem. I love helping people. I love talking to people that trade. It's a wonderful thing. But if you want some specialized help, and it doesn't matter if it's forex or futures, it doesn't matter if it's options or stocks. That's not the hard part. The hard part is being able to stick to your rules, being able to create your rules, being able to understand the mental side. Okay? And I've done that all my life with self-help stuff, with karate stuff, with all kinds of stuff. Oh yeah, the hot list. Okay. Okay. So as I'm talking about this, we'll switch over to that, and I'll show you how to do it. Okay. But if you're interested, send me a note. Yeah, there's going to be a recording of this. So Doug, don't ask me to start over. Okay. But you can send me an email at this address, and I'll give you all the particulars about the mentoring and how it works. My most recent guy that I've been helping out, he was struggling, and he's had 2 sessions with me so far, and he's been profitable for 6 weeks straight now. Okay. But anyway, on the hot list, you find your trading apps tab. Mine is at the top. Some of them are on the side, wherever you keep yours. Okay. You click on your trading apps, and you go to hot lists. Waiting for the YouTube screen to catch up to my screen on my live station here. Okay. So you go to the hot list, and you click on that, and a bunch of stuff will come up on this. Okay. You can see we've got approaching 52-week high, 52-week low, gap up, gap down. Okay. I want the gap up or the gap down percent near open is what it is. Okay. Gap down percent near open or gap up percent near open. The near open is pre-market transactions, pre-market trades. That's what I want, because I'm looking at this and I'm setting these gaps up before the market opens. Okay. And it will come up here and it will list all of these. You can see here there's one JAGX. It gapped 67% this morning. Now these numbers aren't necessarily accurate because this trading day is already taking place, but you can see that it shows you the percent gap, it shows you the last price, and it shows you over towards the end the volume. So I look at that volume pre-market to be 3,000 or more shares traded. I look at the percent to be 4% or higher, and I look at the price to be $60 or more. Okay, so there's your hot list. Okay, this is, let's go one more here. Okay, this is yesterday. I didn't trade today because I had an all-day class with I volunteered for a safety camp, which is something that we put on in our local town here to help kids understand various aspects of being safe. Safe against strangers, electrical safety, water safety, bike safety, all this kind of stuff. Okay, so I didn't trade today. Okay, but this next slide here is UTX, which United Technologies. You can see pre-market on Monday over here on the right. I'm hiding the rest of the day. I don't want you to see it. But pre-market, it opened into a UFO. Okay, at $136 more or less. Okay. So here's my first 2-minute candle. You're going to see it in just a second. What time of day am I looking? I start at 30 minutes before the market opens. And I start evaluating the hot list to see which ones I want to use. Okay. So I'm waiting for this to come up so you can see. Okay. And you can see this first 2-minute candle, the second 2-minute candle, the third 2-minute candle, the fourth 2-minute candle as it develops here on the screen. Okay. This is Monday. You can check this out. You can go to your own screen and look at this. Okay. The others were that I showed you today were all in the past sometime. Okay. So I got into this for $1.89. Okay. This one transversed the gap, you can see obviously. Okay. So at the gap close, you're going to stay in, you're going to get out. You have to have a rule for it, right? Okay. Then we got all this basing in here. Then it continues to drop down. Okay. I got out of this for, I think, 67 cents, and it ended up going down to 45 cents. Okay. And this was Monday. Okay. So we're a little over time. That's all I got. Like I said, there's my email. You guys can send me an email. If you just got a couple of questions about this, what we did today, feel free to let me know. If you want some personalized help, I can do that too. Okay? But this is just an idea for you to take and decide, maybe this is something that I want to do. Okay? I can do single leg long, day trade. Okay? I can do credit spreads. Okay? You could do debit spreads. Okay? There's more ways to do it. Okay? Just take a look at it, find something that works for you, and have at it. Anyway, Jose, I think I'm done. Thanks for letting me come in.
Wonderful, Chuck. Super pleasure to have you in the session today. Thank you so much for. We have a dog in the background somewhere. So, Chuck, thank you very much for joining us today in this session. It's been for sure very eye-opener to some of the attendees looking at using options intraday, which is not a classical, if you wish, way to look at options, but certainly a very powerful way, especially when you're surrounded by the right tools, such as the hot list screener, for example, to speed up the process of your selection of markets and so on, because obviously you have to move fast, if you wish, and use that 30-minute preparation before the market opens to be able to execute efficiently based on the rules. Okay, but again, great one, Chuck, and I'm 100% aware as well that, of course, sharing everything you do in a 1 hour window, it's basically impossible. So
a little tough.
So having this first introduction for the group is really, really fantastic. So guys, please join me thanking Chuck for joining us, and again, thanks again everyone for joining us, and thanks again, Chuck, for being our guide today. And
You're welcome.
We'll talk soon
Glad
again.
I could help out.
Absolutely, we'll talk soon again. You guys
All right.
take care, everybody.
All right, bye-bye.